Joining us now to discuss this and other mega deals, valuations, the M&A landscape at large, Guggenheim Securities Senior Managing Director Eric Mandl. Eric, good morning to you, and thanks for being with us. I wonder if you were listening to the Lina Khan interview over the last hour, perhaps seeing some of the headlines. Maybe you could talk about the regulatory side of this, as it is a big question for the Microsoft, Activision, Blizzard deal, too.
Oh, absolutely. And thanks for having me on. You know, your previous guest was saying this as well, that the tech world in particular is the most dynamic it's ever been in history. And for tech players, in a way, they have to skate where the puck is going rather than where it is now. And this obviously has regulatory and legal implications. It creates a very delicate balance between tech players being strategic versus overplaying their hand. So put it another way, it's very hard to prove the difference between healthy competition versus unlawful monopolistic behavior, especially when you look at that on a global scale. You know, we work with a number of these large tech players, and I can tell you that they are very sensitive to these issues. They take a great deal of care when they're identifying these potential targets. And the key is to develop a point of view where not only the market segment is today, but where it is many, many years from now. And that becomes, the longer you take the timeline out, it becomes more and more complex.
So, Eric, I wonder if you think with all the scrutiny on big tech, does this open the field for some of the names that aren't immediately obvious? We know that Walmart was interested in TikTok once. Disney could be making some moves in the space. We know Netflix, although we can include it with big tech, is interested in gaming. Do you think that we could start to see more deals from these players outside of that mega cap group?
Yeah, I think that's a great question. So, you know, if you kind of take a step back, this rapid rate of change in technology makes almost every company a technology company. So the aperture has become really, really big. That's number one. But number two, at this very moment, we have the largest amount of capital in private hands ever. That's in the form of venture capital and private equity. Plus all of the companies you mentioned and many others have massive cash war chests that they've amassed. So this allows for new and cutting edge technologies to be developed faster, become more disruptive than ever. And the advent of these technologies weave through developer communities. They weave through parts of the technology schema that are not even within a lot of these businesses. So as we think about this through the lens of antitrust, it's absolutely not a static issue. It's absolutely in a state of change. But in addition, your question is spot on. You're going to see a number of players that we don't traditionally think of as tech, thinking about how they play this, whether that's through M&A or through partnership and investment.
Erica, I see this Microsoft Activision potential deal, and how regulators treat it as a huge litmus test. And I wonder if you do as well, because this isn't about free services and data, you know, what's being talked about with Facebook and Google very often. This is about paid digital content, probably the biggest market for it, mainstream market for it, gaming. People are paying, 50 to $100 for downloads in this market and doing subscriptions by the millions. Microsoft itself was a challenger in the gaming market with the Xbox a little over 20 years ago. And you've got Apple that's being challenged for its presence in the gaming market with the App Store anyway. So since it's not about that, if this gets significantly challenged, it might be seen as just anti-big as opposed to being about this new free and data regime. Do you agree, or how do you see it?
I think you framed the question really well. And, I think if you, once again, even open the aperture more, let's go past gaming and let's go across SaaS names or technology, which is so broad. I think the thesis that we have is there are three main variables that run through all of these transactions: scarcity, disruption, and complexity. And I think as you were framing that question, it kind of triggered a thought. The scarcity is, how unique is this technology that's been created? And then if it is truly unique, is it truly disruptive? Will it create material change in the way things are done today? And then last but not least, the complexity. And now for me, when I think about transactions, this one interests me the most. It's applicable here and it's applicable in the cloud. Here's an example of how complex things have become. The cloud, as we know, is public and private, right? Within public and private, that feels like two very discernible levels of where these workloads can live. Then you can have hybrid cloud, which is basically both. And as those workloads live in a hybrid environment, as if that's not complex already, you have a number of different clouds that you have to work on. This is applicable in gaming, in enterprise, even in your home. So you've got Amazon, Google, Microsoft, many others. And this term has developed called hybrid multi-cloud. It's a lot to digest, but the world is going in that direction, and the ability to manage these complex environments is a key to success. I think the lens with which we all need to look through this, whether it's as deal makers or on the regulatory side, is what is the best way to deliver the best thing, whether that's content or a service, to the user. I might also share an interesting analog to all of this, because I think ultimately, not only is this an M&A question, but it's a valuation question. So if we think about all of these complex environments and how they're being managed, if you're a software company today and you're growing north of 30% in a really hot area, say data or artificial intelligence or cyber, you're rewarded with a forward revenue multiple anywhere from 20 times to 30 times, sometimes even more. And by the way, that's adjusted for the recent NASDAQ pullback we've seen. However, if you're in software land and you're growing less than 30% and you're in those same areas, it's tough to trade north of the single digits. So the translation, which in a way is kind of directly answering your question, growth and unlevered free cash flow are the levers that independent companies have in order to affect valuation. But growth still wins the day, and it's directly correlated to that premium valuation. So the lens that we must look through is not only through M&A, but who is doing that disruption, because what this ultimately means is there are many companies that are way smaller than these mega cap players in tech and other areas that do things way better than the mega tech players. Yeah. So that level of disruption is so important, and that's why you see that disparate amount of valuation between the two segments.
Eric, that's a great point to end on as we look at some of those software companies, and we know that they've been sort of seeing this re-rating over the last few weeks, and the NASDAQ down 0.4%, touching correction territory. Thanks for being with us, Eric Mandl.